Hi, and welcome back to the Food Fund, where we analyze investing in food stocks. If you love food and love buying food stocks, beverage stocks, and restaurant stocks, you will love this channel. In this video we will be doing a deep dive into Oatly and exploring their outlook for 2024. Oatly, stock ticker symbol OTLY, is just one of many companies we explore on this channel. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. Just before we get started, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. The channel is growing, which really means a lot. Thank you for your continued support. Now let's go ahead and jump in. Cue the logo. Let's explore a little bit about Oatly's background. Oatly went public via an IPO in 2021 and quickly became a popular stock. Since that time, however, the plant-based producer of oat milk and alternative products has struggled to grow its share price. At its peak, Oatly traded for nearly $29 in June 2021, then fell to its low around 45 cents. More recently, the share price has rebounded to above $1 at the time of this video production. Altogether, Oatly has lost 94% since its IPO, representing a -66% CAGR. Despite the horrendous price action, there is a reasonably solid business at Oatly. When we come over here to market share, we see the market share dashboard. Here we can gather a lot of information at a glance. We know that Oatly is a beverage company, and while alcoholic beverage companies account for a larger portion of the market share than non-alcoholic beverage companies do, the market share growth rates for both sub-industries seems to be very similar. When we click on non-alcoholic beverage companies, we see that Oatly is one of the smallest, but fastest growing companies. With a market share of less than 0.1%, Oatly holds a tiny place in the market, but it is growing its market share at a 32% CAGR. Whoa, that is tremendous. Let's take a look at the year-by-year trends. When we come over here to market share and type in the ticker symbol for Oatly, we see some positive results. The current market share is 0.08% out of the publicly traded food, beverage, and restaurant stocks currently in the market. Nice, but the growth is astonishing. Again, we see a 32% 5-year market share CAGR for Oatly. If we start in 2019, we see that the market share was 0.03%, 0.05% in 2020, 0.07% in 2021, 0.07% in 2022, and further to 0.08% over the trailing 12 months. Out of all of the possible choices for food and beverages, customers are spending an increasingly larger proportion on Oatly each year. Oatly clearly has achieved product market fit, the first step for any successful business. While it is good that market share, and thus revenue, has been growing, free cash flow, or burn in Oatly's case, shows where the problem is. Oatly has been losing money each and every year. In 2021, Oatly burned $488 million and has burned less and less money since. Still, this highlights an issue for Oatly. By subtracting free cash flow from revenue, we get a rough estimate of the cost it takes to run a business. So with revenue of $204 million and cash burn of $93 million in 2019, we can estimate that it took $297 million to run Oatly. In 2020 it took $600 million. In 2021 it took $1.1 billion. 2022 it took $1.2 billion. And over the trailing 12 months it took $1 billion. The cost of running Oatly ballooned 5x in 5 years. This is very bad. The good news is that we can estimate that if Oatly generates around $1 billion in revenue, it should be able to break even if it can maintain its margins and burn rate. But for Oatly to generate $1 billion, revenue would need to increase almost 30%. The last time Oatly's revenue rose at least 30% in 1 year was from 2020 to 2021, when the revenue increased from $421 million to $643 million, conferring a 53% increase. I would be very surprised if Oatly can grow revenue 30% in 2024. In fact, analyst consensus revenue growth for Oatly in 2024 is 6.6%. This would generate around $825 million in revenue for 2024. Why the 1-year time frame, you may wonder? With cash burn for the trailing 12 months at $286 million and cash for that period at $283 million, Oatly has almost exactly 1 year's worth of operating runway before they need to raise money again or declare bankruptcy. However, capital raise options are limited in this scenario. With the share price near $1, Oatly cannot issue shares to raise capital because the dilution would cause the share price to fall below $1, the limit that Nasdaq requires companies listed on its exchange to hold. This leaves only debt to raise money. However, with Oatly's total debt already being $507 million, the additional $286 million required to run the company would result in a total of $793 million of debt. Oatly better pray that interest rates are lowered to near 0% or else the interest payments on that debt will eat the company alive. So if a debt raise is undesirable and an equity raise is impossible, Oatly is only left with one solution: cut costs aggressively. If we look at this chart, we see the cost of goods sold, primarily oats for Oatly, and selling general and administrative expenses. I view the cost of goods sold as a relatively inflexible cost. The price of oats is what it is. There is really nothing Oatly can do to lower this cost besides sourcing the oats themselves, which would be a huge capital expense for many years. Instead, Oatly has to cut their selling general and administrative expenses very aggressively. If we take the $825 million revenue figure based on analyst estimates and the roughly $1 billion it took to run Oatly over the trailing 12 months, then Oatly still has $175 million to account for. Since Oatly has very little influence on reducing oat prices, that $175 million cost reduction has to come from selling general and administrative expenses. This means that if Oatly can get its selling general and administrative expenses down to $225 million, a 44% reduction, then the company might have a chance to break even. When we overlay the number of employees, we see that 1,644 people currently work at Oatly. A 44% reduction of the workforce would leave Oatly with around 920 employees. While layoffs are life-changing and never fun, it seems this is the only way Oatly can get itself out of trouble. The question then becomes, can Oatly run on less than 1,000 employees? I surely hope so. In summary, Oatly has a chance to turn things around in 2024. Market share is growing and customers love the product. However, this is only the first step towards profitability. Oatly will have to cut costs if they are to survive. Many thanks for watching. What do you think about Oatly and their cash burn? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.